I believe it's going to be similar to 2008, where it has a sharp recovery and then builds a launch pad, and then it screams higher, where you're going to $5, $7, $8, $12,000. And so this is ideally what I'm waiting for. Now, gold doesn't mean gold's going to pull back here, but what we're looking for in general, what I'm looking for as an investor, is for gold to pull back and consolidate. And I just want the stock market and the economy to like cleanse itself, have that financial crash, which will probably pull gold down with it. And then as soon as we start to see gold firming up, then it's off to the races. That's when you get into gold, silver. You kind of load the boat up. These because this will be like the next major wave up. It'll be something like this or something like this.
Right.
The gold market continues to exhibit choppy behavior, with Monday's session showing slight weakness. However, this mild pullback is not unexpected, especially considering the low trading volume due to the Memorial Day holiday in the United States. While electronic and futures markets remained open, the reduced liquidity contributed to a modest downward pressure. Despite the short-term volatility, broader market dynamics suggest that gold remains in a strong long-term position. ChrisVermeulen, founder and chief investment officer at thetechnicaltraders.com, anticipates a significant market correction similar to the 2008 financial crisis. During that period, gold sold off due to widespread panic and forced liquidations triggered by margin calls. However, it quickly recovered and outpaced the broader stock market, eventually reaching new highs. Gold is consolidating, with a likely trading range between $3,200 and $3,500 in the near term. Each dip in price is met with buying interest, indicating ongoing investor confidence in the metal's long-term prospects. Vermeulen points out that a potential 34% pullback to around $2,200 would not be alarming, but a regular part of the broader market cycle. He views such a correction as a healthy reset, paving the way for a much larger move higher once the financial system stabilizes. Looking ahead, Vermeulen sees the potential for gold to surge to new heights, possibly $5,000, $7,000, $8,000, or even as high as $12,000, as capital rotates into hard assets amid financial uncertainty. This outlook is further supported by macroeconomic pressures, including rising bond yields, which could force the Federal Reserve to intervene through yield curve control or rate cuts. In such a scenario, gold will benefit significantly, solidifying its status as one of the few widely trusted safe haven assets in times of economic stress. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
If we take a look here, this is a monthly chart of gold. So there's a few layers. I want to start on the big picture of gold and then kind of zoom into the shorter term. So this is when the super cycle started back in early 2000s. We had the big run up all the way up into 2011, and then we've gone into this new correction, and we started a second or another super cycle in 2019. Now, what's really interesting here, Danielle, is Fibonacci theory is one of my favorite tools. Fibonacci is in everything in the universe, and I use it very often for price action to identify where something is going to move to. And if we take this first massive bull market, this super cycle rally, down to this low, and we just carry it over to the right-hand side, it's going to show us where the upside target for gold is. Now, this is something we were able to project over here in 2019. I said, hey, listen, now that we've started a new super cycle, the maximum target we should see is about 27 to 2,800. And you can see we hit that price. Now, what's also interesting is the newer super cycle that started in 2015 and it hit this level and then it pulled back here. If we carry it over, both of these cycles are pointing to roughly the same price. And so those are rock solid levels. Now, what is really interesting here is each time we've hit one of these Fibonacci measured moves, there was another Fibonacci measured move over here. There was another one over here, another one right over here, and another one over here. And so you draw these levels as the charts are unfolding. And each time we've hit one of these levels, we've seen gold have this giant push up in this big rally. And each rally, believe it or not, has been 22 to about 24% to the upside. And that's exactly what we have just seen right now. So we're in this stage where gold tends to perform exceptionally strong and take off. It's hit our target. Anything after this really, to me, is like icing on the cake. We're like, okay, now everybody's piling in. People are really bullish on gold, so they don't want to sell, which means if people want to get in, they got to pay top dollar for it because the investors are saying, I'm not giving it to you until you give me a much higher price. And so I believe we're going to come into a larger financial correction that will pull gold back, very similar to the 2008 pullback where gold, had a pullback of about 34%. So I think that's where we are. I believe we're like right here. We're on this little blow off phase for gold. The economy's rolling over. And I remember the world, everything seemed to be slowing and coming to an end. I actually sold one of my businesses, just before the market collapsed because things were slowing. I could see it coming. I'm like, you know what? Let's just exit this business. Let's sell it, and we can get into something different after a financial reset. That's exactly what I did. So that's kind of where I believe we are right now, is this scenario in gold. And gold has put in these kind of tweezer bars, these little wicks that run way up and then the price gets slammed back down. It's happened twice. They generally signal a reversal type of pattern in the charts. Not always. Sometimes it will just indicate a pause. But once we've hit 100% measured move and we've got into this blow off phase and we're seeing the stock market really struggle, economic data is starting to struggle, gold is shining. Actually, one of the really interesting charts is check this out. So this is a very interesting comparison with gold. Right. So if we were to take a look at what gold did in 2008, so the stock market, which is the candles chart pattern here, put in more or less a double top. It had a big 20% correction. And interesting enough, we put in a double top here with gold, with the S&P 500. And we have seen gold shoot higher, just like it did in 2008. So stocks are topping and money's moving into gold as that defensive play. I told you, people are nervous about the financial system. They want to get away from the banks and all of that stuff. And then the stock market, as you'll see, eventually sold off and it crashed. The stock market fell 57% from the highs. And when we go into a bear market, it tends to pull gold down temporarily with panic selling. And then we tend to see gold will turn around and it shoots to the roof. So we have the exact same scenario unfolding right now. And the one thing the caveat here, or the one thing I should mention is everybody's going to be like, this is nothing like 2008. And I get that. Every bear market and every scenario is never really like the past one. The tech bubble was this very similar situation. Yeah. A bear market is a bear market. When you rip out the economic data and the news of what people think are causing the movements, and you just look at the price charts, price does, three things. It moves up, it goes sideways, or it goes down. And it's pure driven on fear. And so we're just at a point. Doesn't matter what the reasons are, but people globally are getting nervous. They've been flocking to gold. The stock market's had its first 20% correction in this big bounce, just like it had a bounce over here before it rolled over and sold off. And this is a complacency type of move in the market. This is what I call a complacency move. And I believe we're going to see something similar here, where the stock market trades sideways for a while and people think we're starting a new bull market. But it's a very interesting scenario that the same setup is happening in the price charts like they did in 2008.
The U.S. stock market is aiming for a positive open on Tuesday. Futures rallied on Monday following news that President Donald Trump would delay the implementation of a proposed 50% tariff on European Union goods. Initially set for June 1st, the tariff has been pushed to July 9th, giving markets a temporary boost. According to reports, futures for the S&P 500 rose by 1%, while the Dow Jones Industrial Average futures gained 0.8%. On Friday, the S&P 500 fell 0.7% to close at 5,802.82, marking its worst weekly performance in 7 weeks. The Dow Jones Industrial Average lost 0.6%, settling at 41,603.07, while the Nasdaq Composite dropped 1% to 18,737.21, as traders questioned whether Trump's tariff threats were genuine or part of ongoing negotiations. Despite the short-term optimism in equities, market analysts remain cautious. ChrisVermeulen refers to the current bounce in stock prices as a complacency bounce, a temporary recovery that could precede another significant downturn. He parallels the 2008 financial crisis, suggesting that the current setup bears striking similarities. While each cycle has unique triggers, the underlying patterns and investor behaviors often mirror past crises. In this environment of uncertainty, gold continues to act as a haven. As in 2008, when gold initially fell alongside equities due to widespread liquidation but later surged to new highs, investors are again turning to precious metals as a store of value. The charts, Vermeulen notes, are beginning to rhyme with past cycles, indicating that while history may not repeat exactly, the market dynamics are unfolding in a familiar pattern, one where caution is warranted, and real assets like gold could be key beneficiaries. Let's get back to the interview.
If we were to use a Fibonacci retracement, which tells us where gold could pull back to based on the analysis in this peak, It's telling us that gold, we can just go to the peak here. And if you look at 34%, it's roughly a 38% correction from the original the first super cycle of gold. So that's bringing us down to about 2,200, which is obviously a pretty precipitous drop. But that is normal for what gold has done in the past. And then after that, I believe it's going to be similar to 2008, where it has a sharp recovery and then builds a launch pad, and then it screams higher, where you're going to $5,000, $7,000, $8,000, $12,000. And so this is ideally what I'm waiting for. Now, gold doesn't mean gold's going to pull back here, but what we're looking for in general, what I'm looking for as an investor, is for gold to pull back and consolidate. And I just want the stock market and the economy to like cleanse itself, have that financial crash, which will probably pull gold down with it. And then as soon as we start to see gold firming up, then it's off to the races. That's when you get into gold, silver. It's a kind of load the boat up. These because this will be like the next major wave up. It'll be something like this or something like this.
Right.
If we were to just look at this financial reset, and this is 2008, the stock market started to sell off. When people panic, they start to sell everything, even the good investments like gold. And there's also margin calls, which force liquidation. And gold's a pretty small market, so it gets pulled down with the selling pressure. But you'll notice gold bottoms out months and months or a year before the stock market will. It'll bottom out. And then, of course, it'll be off to the races and want to shoot up dramatically higher. And gold is going to be that safe haven play. People are going to start to say, okay, everything is falling. Get me out. I want to move into gold. Get me, it's the natural tendency of, what people go to. They're like, nothing's good. Gold's going to be holding up percentage wise, probably better than everything else. And so that's where people are going to want to move into. And especially when it starts to run, then it's just going to be that play that everybody's like, I don't trust the stock market anymore. There's still a lot of people out there that hate the stock market because of their experience of 2008, and it's moved people permanently over to gold. So gold is that it'll always be worth something. Generally, it'll be worth more. And the perfect example, Danielle, is we had the power go out in Canada or the internet once. Pretty much all of Canada was out for a day. And I went into town and I sat at this cafe, which had a different type of internet connection. We've got like 3 or 4 major internet providers, and the main one went down. And I'm sitting there trying to do my morning report and analysis. And this guy says, "Hey, Chris, how's it going?" And he's like, "Can I sit down and talk?" And he was a fund manager. And he goes, "You won't believe what I just did." He goes, "I went to the gas station and he had 2 silver rounds on him." And he says, "I filled my car up with 2 silver rounds. You couldn't pay with credit card. Their systems were down. And when push comes to shove, gold is the ultimate currency. When you don't have any power or internet, you can still pull out a little brick or a piece of gold or a round of silver, and you can buy stuff." And
I just did a whole segment on that. It's crazy you mentioned the story. Please.
Yeah. No, it blew my mind, and I've got gold and silver all around me in my room because it's the same thing. If something happens, it's just like us having a generator with fuel. You've got to have like a backup, but gold and silver are like the ultimate thing. And my big concern is if we ever do go into some type of war to me now is like cut off the internet and we're screwed. Like crypto is worthless when there's no internet, right? But gold and silver are the ultimate. I don't think the retail investors are there at all. I think the only reason gold's really taking off is because people who hold gold and like gold, they don't want to sell it. So there's just people moving into gold. Not a lot. It's not like a flood of retail investors. Gold and silver is like a fraction of a percent of most portfolios. Advisors don't give a crap about it. Like nobody's really sucking it up. There is no real demand here. It's just there's not a lot of supply. People don't want to sell it because they know it's in an uptrend and they like it and it's shiny and it's going up in value. So it only takes a few buyers to drive it up. I think after a financial reset, we'll probably see the movement of people back into gold, and it'll become a big percentage of a portfolio, like 1.5%, 3% of portfolios on average, which would be huge, considering right now we're like a quarter or a fraction of a percent of normal portfolios. So no, we're nowhere near the retail. It's just people who aren't in it and see it every day. They have so much FOMO because it just keeps pushing up, and it just lures and sucks them in. And they're like, you know what? I have so much FOMO. I have to buy at this price. I do see things looking pretty bleak. I feel like from a technical standpoint, I'm a technical analyst, so that's my number one gauge of understanding the economy and equity prices and commodity pricing. But even when you look at businesses and some economic data, to me, everything is slowing, everything is turning around. And to me, it looks like a stage 4, which is a financial reset, kind of like the tech bubble, the 2008 financial crisis. I think we're going to see a big unwinding, and there's going to be a reset among pretty much all asset classes. And we don't see these obviously very often. And a lot of new investors have never even been through something like a 2008, a big crash. So it's going to be pretty eye-opening. And that's what I'm trying to do, is help protect as many investors as possible, because I think what's coming up is going to destroy millions, tens of millions of retirees' retirements if they are not careful with what's going on. I think from a technical standpoint, when we look at, the financial markets are all linked in some way. So if one asset class is generally coming down, that money's coming out of an asset, it's moving into a different asset class. So for example, in the last week or so, or actually a month or so, we've seen kind of money rolling out of gold, and it's been going into the equities market. So usually money is sloshing around between the various assets. Gold is to me one of the key barometers, global barometers of that we're going to have a financial reset, not just in the United States or in Canada, but it's going to be global. And we're starting to see this. And obviously the tariffs have definitely kind of created the first shock wave that sent a shot across the bow to go, whoa, these markets can drop very quickly when something goes. But gold is telling us there's global fear. People are worried about another financial crisis, and gold is that way to protect your capital in terms of, even if you were to sell your assets and put them in a bank, that bank could be gone with all of your money. You could do the right thing and move to cash and protect yourself, but still lose all your money. So that's why we're seeing, I think, a big movement into gold, is because you're getting out of the financial system, you're holding physical assets, and more or less, it's kind of like an insurance plan. If things are going to go bad, you still have physical gold that you have. It's not a fiat currency. It's the real deal. And so I think that's, gold is going to be definitely a defensive play. And it has been right now. We're definitely seeing money move into that. I think it's going to be very similar percentage-wise. I think the S&P 500 could fall roughly 47 to 55%. We saw that. We've seen this happen in 2000, the tech bubble with the S&P 500. We've seen it in 2008. We've seen it in previous crashes even before that, many, many decades ago. So it's not out of the norm. Like heck, during COVID, the stock index fell 34% like that. It doesn't take much. If you look at 2008, in a pretty much a 3-week window or 4-week window, the S&P 500 fell like 35%, just like what we saw in COVID. So things can happen very quickly. I think it's going to be another financial reset for a different reason. This time they're always different than the other, but I do believe it's going to be similar to 2008, where it's going to start to roll over and there's going to be a very precipitous, sharp collapse in pricing, and it's probably not going to drag out too long. But if you're late on the trigger to protect your capital, move to an asset that's safe, you're going to give you in trouble, right?
As global financial conditions grow more unpredictable and investors weigh the risk of prolonged economic strain, safe haven strategies are gaining renewed relevance. Despite near-term fluctuations in equities and precious metals, long-term positioning increasingly favors tangible assets amid tightening monetary pressures and the potential for continued market turbulence. With uncertainty surrounding fiscal direction, inflation control, and geopolitical stability, market participants are shifting their focus toward assets historically known for preserving wealth. Gold, in particular, is emerging as a hedge and a strategic core holding in an era defined by shifting capital flows and fragile confidence in traditional instruments. Could the subsequent financial upheaval transform gold from a defensive play into the centerpiece of global investment portfolios? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.